In this week's update, Omicron takes its toll on markets and attention focuses on the Fed's response. Market volatility has become an either-or event. It's either calm as a mill pond or choppy like the mid-Atlantic. Last week, after an extended period of smooth sailing, investors felt the full force of the COVID storm. The discovery of a new variant, quickly named Omicron, had markets pricing in a worst-case scenario in the absence of any real facts to go on. The new strain, incubated in southern Africa, was predicted to spread rapidly around the world, and so far that seems to have been what's happened. That's how it works in an interconnected global village. Governments have moved swiftly to avoid the charge levelled at some 18 months ago that they were too slow to take COVID seriously. But the political challenge of imposing new restrictions, let alone lockdowns, is clear to see. Especially in the run-up to Christmas, no politician wants to be Scrooge. The market reaction was rapid and uncompromising. The FTSE 100 felt the full impact, falling by more than 3.5% on Friday. Wall Street followed suit, but trading was impacted by the extended Thanksgiving holiday, so it was harder to read what investors really thought in a market where many of the decision makers were on holiday. The S&P 500 was down by just over 2%. Asia caught up on Monday with falls in Japan, Australia and other regional markets. Friday's market rout certainly got the Santa rally off to an unfortunate start. Typically, the period between Thanksgiving and the end of the year is a good one. Here in the UK, markets have risen in December 25 out of the past 30 years. It would be a brave call to bet on it happening this year, although you could certainly argue that last week's dive increases the odds. Inevitably, there was a partial recovery early this week as investors accepted that they may have overdone the rush to the exit on Friday. The nature of modern markets, driven in large part by risk management algorithms and automated trading, means that this kind of event, the impact of which is hard to measure, tends to deliver an overreaction. In the short term, the market certainly looks a bit oversold. The proportion of stocks trading above their 20-day moving average dipped to 21% at the bottom of the recent range. Volatility also spiked higher, but not massively so. For now, this looks like a common or garden market scare. How serious it turns out to be will take a few days, maybe weeks, to become clear. All eyes are really on how the authorities react. Market expectations for future interest rates have fallen back, but what the Fed decides to do in response will be governed by a complex cocktail of factors, including stock market performance, the level of the dollar, long and short bond yields, and bond spreads. The Fed tends to react when financial conditions, as measured by the combination of all of these, tighten. In 2016, a tightening of conditions forced the Fed to hold fire. After an initial attempt to raise interest rates, it waited a full year before its second hike. Then, in 2018, another tightening of financial conditions obliged the new Fed chair, Jay Powell, to put monetary policy into reverse, sending rates down from 2.5% to close to zero again. Much will also depend on what happens to inflation expectations. Obviously, if Omicron turns out to be as transmissible as feared, and if it proves resistant to existing vaccines, then the global economy could take another big hit. Further lockdowns and travel restrictions could mean that the recent high inflation readings on both sides of the Atlantic prove to be the peak for this cycle. Of course, that doesn't mean that the inflation worry will have disappeared. Something similar happened in the late 1960s when price rises seemed to go into reverse only for a couple of big spikes in the 1970s. We'll get the latest insight into the inflation picture this week when Europe reports on prices with a 30-year high reading on the cards. That may prove to be a last hurrah for the inflation hawks. Container shipping costs are already falling, and last week's $10 fall in the oil price showed how quickly big contributors to the overall inflation level can move, although Brent and WTI have bounced back again somewhat this week. The Omicron scare has taken the edge off the recent performance of the stock market, but the underlying picture remains the same. The US market in particular remains close to its all-time high, but the trajectory of the bull market is likely to flatten somewhat from here, thanks to slowing earnings growth, albeit from a high level, and a continuation of the last year's fading away of valuation multiples. The big exception to the market story this year has been emerging markets, which have retreated largely on the back of the poor performance of the Chinese market. China has been dragged back by problems in its property sector, its decision to try and eliminate COVID rather than live with it, and an unwillingness to repeat earlier episodes of massive stimulus. Investors tend to follow relative earnings, and all of the above have ensured that China is lagging the US on that front and is likely to continue to do so. So, we've been here before. The emergence of the Delta variant in the summer caused a similar market wobble that soon unwound itself. Whether that turns out to be repeated this time around will depend on whether other circumstances are different now. First of all, the latest COVID scare comes as the Fed is preparing to taper its stimulus in response to high and rising inflation. The backdrop is certainly less supportive than it was 6 months ago when people were still receiving government handouts. The second question is how governments will respond. Restrictions have become a political issue, and the willingness of voters to put up with further curtailment of their freedoms is unclear. A third question is how we respond as workers and consumers. Many of us were coming round to the conclusion that we were over the worst of the pandemic. If that's not the case, how will that affect our spending patterns? We just don't know. And as the last lockdown showed, it's not all bad news. Spending shifts, it doesn't necessarily reduce. Finally, and perhaps most importantly, we don't know much about Omicron itself. If it renders all the vaccinations so far useless and we're back at square one, well, the market reaction over the past 18 months will seem far too optimistic. But that's pure speculation. It could easily go the other way. We're already hearing that the impact of the new strain has been mild. Lifting our eyes from COVID for a moment, something else that's worth noting this week is the health of the global IPO market. Although shares have soared throughout 2021, new arrivals on the stock market have fared much less well. Half of the bigger companies, raising more than $1 billion on flotation this year, are currently trading at less than their IPO price. High-profile flops have included Deliveroo, Oatly and Paytm. It suggests that investment banks have been too greedy on the back of the market's recovery. A year on, fewer of 2019's and 2020's crop of IPOs were underwater, 33% and 27% respectively. The poor performance of stock market flotations is likely to increase the already buoyant interest in private equity markets, where lower valuations and a wider universe of opportunities in alternative assets like real estate, infrastructure, natural resources and private debt markets is leading to an expected 60% rise in non-public assets under management between 2020 and 2025. And finally, in case you think that we have it bad, spare a thought for Turkey, where interest rates have been cut for 3 consecutive months but still stand at 15%, even as inflation looks set to exceed 20%. On Friday, we will learn if prices are rising above that level, as predicted by the latest Reuters poll. The Turkish lira has fallen by 28% against the dollar just since the start of the month, and the latest talk is of hyperinflation.